this series again for this semester, the political economy of liquidity, and we're absolutely thrilled to have both Nelly Liang and Stefanos Gambati with us today for the session called Treasury Market Stability and the Big Whale, Hedge Funds and their Role of Liquidity Provision in Tumultuous Times. As you know, usually what we do is we have the two speakers share for 15 minutes, about 15 minutes, their views, and there will be a short discussion between the two. And then it's for all of us to chime in and to throw as many questions at them as we like, and then have just a really good and civilized discussion on the question of political economy of liquidity and the treasury market in particular. And so, without much further ado, I would now like to start with Nelly Liang, who's the Senior Fellow in the Hutchins Center on Fiscal and Monetary Policy, former Undersecretary for Domestic Finance at the U.S. Treasury, and before that, the leader of the Financial Stability Division at the Federal Reserve. It's our great honor to have you, and she will be followed by Stefanos Gambati, Senior Lecturer of International Political Economy at St. George's University of London. Without much further ado, Nelly, the floor is yours, and just take it from here. Thank you.
Okay, terrific. Thank you. Matthias and Katerina, thank you for inviting me to speak today. I'm going to share my screen, just make sure I can get this to work. Does that look okay? Let me get it back. Okay. So thank you. So I am really pleased to talk about the political economy of liquidity and treasury markets. As Matthias said, I served recently as the Undersecretary of Domestic Finance at the Treasury Department, which is responsible for issuing the treasury market debt. And so building on work I had been doing at the Federal Reserve and at Brookings before that, I went into this administration with a pretty strong agenda for reforming the treasury market to ensure that liquidity would hold up in periods of stress. And so this is called ensuring liquidity and resilience. I have a number of slides today. I'll talk through some of them, but some of them can be available later. So treasury market reform. So just some background, as you all know, Treasury securities market is the world's deepest and most liquid market. It serves as a cornerstone of global finance. Excuse me. Treasury securities finance the government, the federal government. It anchors the risk-free yield curve for global markets, and it serves as a safe asset. Part of the work that has been done on reform was really started in a deliberate and extensive way after September 2019, but maybe perhaps more significantly March 2020, which exemplified some significant period of stress. And it showed some structural vulnerabilities in the market that can lead to a loss of market liquidity. And that is something that the Treasury, the Federal Reserve, and society, the US economy, would want to prevent. So just a bit more background. The Treasury market does not have a single regulator. So I should just put that in perspective for those. It's surprising. It is neither the Treasury nor the Federal Reserve, but it's both and the SEC, and then also the CFTC because of the very closely linked derivatives markets to Treasury securities. And in this market, there's been a lot of changes in recent decades. And I would start with technology. There was the growth of electronic and algorithmic trading by many new entrants starting in the 80s and 90s with high fiber optics and that kind of thing. So we have a lot of PTFs. And more than half of the actual Treasury securities trading is done by PTFs, who are not dealers necessarily. Post global financial crisis, regulations had a significant impact on the way Treasury markets worked. The intermediation provided by dealers was scaled back because capital requirements were raised, risk management standards were raised, all for good reason, but it did have an impact on the willingness of dealers to intermediate in stress and their ability. So, willingness and ability. So, those are two things. At the same time, I would argue, and this has been part of my agenda, that Treasury market liquidity has become even more important for the system. As banks have scaled back in terms of intermediation, including in lending, there's as a source of credit, they are shrinking. Treasury markets and securities are the main source of liquidity for the financial system. Banks have reserves at the central bank. Non-banks do not have reserves. They need something else. And it's either cash, currency, and treasury markets, treasury securities. So the investor base also is changing for treasury markets and becoming more price sensitive. And I'll just show a chart of that in a few minutes. At the same time, in recent years, the amount of treasury debt has been climbing very quickly. And then the fourth point I would make, which is pretty critical to how to think about all this, the Federal Reserve mandate for price stability in this era where inflation has been rising could conflict with purchasing treasury securities to support market liquidity. And I'll say a little bit more about that. So there are a number of reasons for why treasury market liquidity is ever more important. So just to show a few charts, the left side is just the marketable amount of treasury securities to GDP ratio from 2000 to 2000. I believe this goes to 25, but maybe not quite 25. But you can see that prior to the global financial crisis, it was 30% of GDP. It's now touching 100, and it's expected to rise to 120% by 2036. And on the right side, I just highlight the debt to GDP ratio, where it includes business, which is the dark blue on the bottom, which has not changed all that much since 2000, household, which is green. And you can see that has shrunk from the height of the global financial crisis. But and government debt has risen in part to offset some of the household debt to support, but it has risen by more. And so total debt to GDP is pretty high for the US. Just a few more facts about Treasury securities. As I said, it's about 100% of GDP, 31 trillion marketable, projected to grow to 120%. In terms of composition, just for information, 6.6 is Treasury bills. So, and then 21 plus 3.4 is notes and coupons. I highlight those because it's the 21 that has the duration risk and is more difficult to intermediate. And, the off-the-run securities are all the notes and bonds. The bills are marketable short-term. And so the amount of duration risk associated with treasuries is significantly different. The last bullet point here, I just want to emphasize, Treasury repo daily transactions currently are at primary dealers is $6.1 trillion per day. OFR, using a new data set, has about $8.8 trillion, including all participants. That's beyond the primary dealers. So this is saying that the funding markets, so the Treasury repo market is how many participants fund their purchases of Treasury securities. And it is sizable. I mean, 6.1 or 8 trillion is a large amount of funding on a daily basis. Much of this is overnight funding. So it's in some ways to think about liquidity of Treasury securities and the ability to trade, to purchase, trade, finance relies on the repo market. This is a chart I wanted to include just to give a sense of what is happening to who is buying and holding Treasury securities. And the point here is that investors who are more price sensitive, their share has been rising. So on the chart, the graph shows holdings of Treasury debt, and this is a share of Treasury debt by the blue, which is rest of world. So think of foreign central banks, could be sovereign wealth funds as well. The Federal Reserve, which is yellow, and then depository institutions, the small orange there. And from, say, 2015 to current, that share was above 70% in 2015 and has fallen to 50%. So these, who I would call less price sensitive investors, the foreign investors and Federal Reserve in particular, are reducing their share, their holdings of Treasury debt. To offset that, more price sensitive investors have become much more significant. And so in 2025, money market funds held 22%. That's probably bills. Mutual funds held 13% of treasuries, and then hedge funds held 9%. Okay, so what was the reform agenda about? And it was called the IAWG Treasury Reforms. In part, IAWG means Interagency Working Group. And as I mentioned, there is no single regulator for Treasury securities. So what was the principal goal? Were their principal goals? One was to strengthen the trading infrastructure. So as I mentioned, technology's been changing for decades and regulations had not been keeping up. But the more important things for liquidity are to be able to the structure to be able to expand intermediation capacity in stress periods, and to also, so this is like the supply of intermediation, who will offer liquidity, and then to also manage surges in demand for market liquidity and stress. So as the non-bank sector is growing relative to the bank sector, and some adverse event happens, they may need cash. And so they will sell Treasury securities. And how do we manage those surges in demand when they want to sell Treasury securities? So there are some major work streams, which I will go through. One is to improve data and disclosures, 2, review bank capital regulations, 3, expand central clearing, and then 4, look specifically at private funds that are leveraged or have significant maturity mismatches and see if you could implement changes that reduces their surge in demand for market liquidity in these stress periods. Okay, now what is market liquidity? Just to make this all more tangible. And it turns out to be very difficult to measure. And so I was sort of on the inside at the Fed or at Treasury, and I had access to measures of market liquidity when I was there based on proprietary or supervisory data. Once you're on the outside, it's very difficult to get real-time measures of market liquidity. But what I have here, what I'm showing here is one proxy, and this one is called market depth. And it's basically quotes from a dealer. And this one in particular, I would say JP Morgan, they shared this data with us, allowed me to show it. And it's a quote that's, somewhere between like in the morning hours. And it's quotes for some of the coupon securities, say 2, 5, 10, and 30, what they're willing to take. Okay. So this time series goes back to 2014. You can see it varies a lot over time. And it used to be it's so anyway, it goes through 2025. What I do on the right side is use the market depth measure as a measure of market liquidity. And that's on the vertical axis. And on the horizontal axis is a measure of market volatility. So, like, this is the move index, it's interest rate volatility. And the little blue dots here are all the observations daily since 2019 to today. And you can see that when volatility increases, interest rate volatility increases, market depth, a proxy for market liquidity, tends to fall. And there's a nice inverse correlation. And this is literally just the scatter plot. And that usually holds. So it's, of course, as volatility in the markets go up because there's new news, some new event like a war, like whatever, that will drive up volatility, and dealers will pull back risk taking. They have to manage their risk, and so they pull back on their market depth. Now, there are some highlights here that I want to, the dotted points, the colored points that I want to highlight, and just to give you a sense of how this market can function. So first, let me see. The very dark blue lines, which are on the lower, I don't know if you can see this, lower left-hand, lower quadrant. This is March to April 2020, the dash for cash, when for this amount of volatility, say the move index between, say, 60 and 100, market depth was way below normal. So that is just a fall off in volatility. The gold dots are the March 2023 bank runs, SVB failure, SVB and signature failure. And you can see interest rate volatility went way up. Now, these liquidity fell, but not terribly outside the realm of what was expected. And and this was a market shock around interest rate volatility. That was what was happening. People were surprised by the interest rate risk at banks. And then last year in April, with the announcements of the tariffs, that the president was going to raise tariffs on everybody, what was called Liberation Day. Those are these reddish dots in here. So volatility went way up, but the depth, the market depth, the amount of liquidity being offered did not fall off that much. They're sort of, again, within the range. So I think this episode of March 2020 and March to April 2020 is like the really sharp and distinct episode. So what was that episode? So as I said, Treasury market liquidity collapsed in this dash for cash. And there were several things that happened. Foreign investors were selling Treasury securities. Mutual funds faced massive redemptions, the largest redemptions on record, and were selling Treasury securities. And hedge funds were selling Treasury securities. Ex post, we know that they're in roughly equal proportion in terms of quantity, maybe not speed, but quantity. So much of the attention on this event is about the cash futures basis trade, and which was related to the hedge funds having to sell Treasury securities quickly. So and I think Stefano will talk a little bit more about this as well. But what is this cash futures basis trade? It involves a number of different players in the market. You have asset managers, think of mutual funds, that purchase Treasury futures to get interest rate risk exposure, and that drives up premiums on Treasury futures. So they are buying Treasury futures instead of Treasury securities. And let's think of those as trying to match a aggregate bond index. Their mandate is to match the Barclays aggregate bond index, which has 40% Treasury securities, say. So they have to buy Treasuries or get the interest rate risk. But they're buying futures instead of Treasury securities. So what hedge funds do then is they come in and they short those Treasury futures because the premiums have been built up. They then they hedge that position with Treasury securities that they fund in the repo market. So as market volatility rose in the pandemic, the dealers pulled back on risk taking. Hedge funds lost their funding and had to liquidate treasuries. And this was a very unusual event for treasury yields to rise. Prices are falling when equity prices are also falling, and raised lots of concerns about the loss of treasuries' safe haven quality. And that led to the Fed having to step in and purchase large amounts of treasury securities. So I think when we think about this cash futures basis trade, we need to think about that there's multiple frictions in this market. Why are asset managers using futures instead of treasuries? And why they're gaining leverage that way. The hedge fund leverage for repo, is it too much leverage? And then why the dealer reluctance to intermediate in stress. Okay, so I'm going to go through. So with my screen, Matthias, you're going to have to tell me how much time I have. I'm going to go through a few of the reforms that we have, and maybe not all in
3 minutes.
As much detail. Yes.
Yeah, would be good. 3 minutes would be good.
Okay, so I'll have to go very quickly. Okay, capital requirements. Let me just, I'm going to highlight a couple things. Capital requirements, because I think this is probably something people are quite interested in. So there's been the supplementary leverage ratio is a capital requirement applied to the US G-SIBs. That's the largest globally systemic important banks. The leverage ratio is designed to be a backstop to risk-weighted capital requirements. And that's because sometimes in a stress event, what you think are not risky assets turn out to be the risky assets. So you just say, we don't care what the risk weights are. All assets are just going to get the same risk weight. In the United States, the G-SIBs are subject to something called the ESLR, the Enhanced Supplementary Leverage Ratio, which adds a surcharge and say it's 2% for the holding company, and it adds it to the Basel III 3% minimum. So in the United States, the largest G-SIBs had a surcharge. What this has done, arguably, is that the higher level has increased the likelihood that this ESLR was not a backstop, was not functioning as a backstop, and therefore was reducing its incentives to intermediate and in low risk, low return activities like treasury market intermediation. So during the crisis, the banking regulators actually temporarily relaxed this ESLR by excluding reserves and treasuries from it. So dealers could help support market liquidity. The bank regulators in the last few months put out a proposal early last year and then finalized it in the fall to reduce the ESLR. And what it's done is lower the surcharge. So for a holding company, instead of 2%, it's going to be half their G-SIB surcharge. And in effect, it's going to be somewhere between 0.25 and 1.25. Now, I was in favor of this reduction. I was in favor of this reduction in 2020, even before I went back to Treasury. And at current levels of capital, risk-weighted capital requirements, this reduction in the ESLR does not lead to a reduction in capital requirements at banks. It's very little. They're not, it would result in very little dividends or share buybacks because of this reduction. And then I would comment that the banking regulators did not permanently exclude Treasury securities and reserves, which the banking lobby had been pushing very hard for, and is what they did in April 2020, because they did recognize that long-dated Treasury securities have interest rate risk, and that is not in the capital requirements. So they took us interim step, and I think there will probably be a little bit more. Okay. Expanded central clearing is a huge effort that is being going forward that I wrote a paper on, distributed. It's a bit technical, but it will allow dealers to expand their capacity by netting. But what it also does is introduce standardized risk management practices into this market, in the repo market. So all we're doing, it looks simple. In the non-centrally cleared repo, the dealer stands between a money fund lending cash and a hedge fund lending securities, and the dealer's the client's counterparty. In centrally cleared, the clearinghouse then steps in, and the dealer is no longer the client's counterparty. But these clients post margin to the dealer has to guarantee the performance of its clients, but the clearinghouse can set margins and it standardizes risk management practices. This is actually a very important step. It's a multi-year effort, and the industry is well on its way to getting there. So I think the two things I would highlight, its benefits, again, reducing risk, standardized risk management for margins, daily mark to market. There's much more visibility into market conditions. It allows dealers to net. There are some costs for sure, potentially higher transactions costs. And then if unaddressed, margin practices could become more pro-cyclical. But I think there will be some efforts to take care of that. What this does not do for the cash futures basis trade, though, is address why asset managers can leverage using futures, and they choose futures over Treasury securities, which gives rise to the whole cash futures basis trade. But there is some other work doing that, but expanded central clearing. Okay, let me see. Just one more thing I wanted to add.
Okay, one more thing.
Yeah. Two things the official sector has done to help the Treasury market. Since the crisis, the Federal Reserve has put in a standing repo program, which allows dealers to sort of repo with the Fed. It's only partly successful, but it's there as a backstop. And then Treasury itself has initiated a buyback program to let dealers sell securities to Treasury. Now, since Treasury can't create money, anything it buys back, it has to issue in terms of new securities, but it is easing dealer constraints. So my last points, Treasury security, this is just summing up, Treasury securities and funding is critical to the liquidity of non-banks, which are a growing proportion of our financial system. There's a lot going on. It is still ongoing. This current administration appears to prioritize Treasury markets. There are concerns about, though, that we should not let leverage at banks rise too much or margins get too low. But I guess, and this is the last point I really want to make, financial regulations, as good as they are not going to solve the fundamental risk of the rapidly growing amount of Treasury debt. So I think in terms of what is happening in the system, we can make the system stronger, but a fundamental problem is just there is a lot of Treasury debt. Okay. Thank you, Matthias. Sorry for going on.
Oh, wonderful. Thank you very much, Nelly. I think you've laid a wonderful ground for this discussion. We're going to have, and I think many people have many questions, and we'll make sure that there will be enough time for that. Now we will have Stefano, maybe with a slightly more political economy take on the same issue. And then after this, we're going to go to the questions and discussion.
Yeah. So do I need to stop sharing?
Yes, I think you should.
Okay, but I'm trying to,
I can also replace, apparently. I'm going to try. Can I?
Can somebody tell me how to stop share? Because I expanded my screen.
Maybe let's see if
There we go.
Yes, it's working. Wonderful.
can you see me? Can you see
Well,
my
like-
okay,
Yes.
Got it.
Now you just need to share the full screen and we're good.
Yeah. All right. Just gonna move this out of the way. All right. Thank you very much for inviting me to this very exciting talk. Today I'll talk about hedge funds, the Treasury market, and leveraged finance. So I'll broaden the scopes a bit and how all of this factored in the repocalypse and why this is not just a 2019 thing, but something that will represent the structural feature of the Treasury market. So this presentation will draw on an article that is currently under review, I think, but it builds also on a book that I've nearly completed. It's basically done. Now the hard part comes, which is to get it published. And this book is Absentee Debtors on the Politics of Leveraging Contemporary Capitalism. By absentee debtors, I mean those economic elites whose wealth and power stems not just from the ownership of assets for the asset management complex, but from their capacity to leverage on a massive scale via corporate structures, legal proxies, LLCs that they control. These can be hedge funds, private equity firms, but others too. And absentee debtors, I argue, thrive by shifting risks and costs associated with their leverage onto the broader financial system and, of course, society. So today I'm not going to talk about absentee debtors. I'm going to make a fairly simple argument, I hope, and that is the hedge funds, together with the dealer banks, form part of what I call a leveraged finance complex. And this complex links together three domains that are often studied separately. That's the US Treasury market, and more generally, safe assets, the dealer system, market makers, the big banks, and the repo finance system, and the corporate credit market, including especially speculative grade, corporate debts, leverage loans, junk bonds, and how this links to private equity, and a shadow banking complex as well. So my claim is that these domains are deeply intertwined, and once we look at them together, something important becomes clear, and that's the fact that safe assets, and especially US Treasuries, are not as safe as we often assume. As Nelly has already pointed out, they have become increasingly vulnerable to episodes of hedge fund deleveraging and margin spirals. For instance, in March 2020, but also in April 2025. But I would say also in January, February 1994, during the so-called Great Bond Massacre. But let me begin my story with a concrete episode, which is precisely what I call, what many have called the repocalypse, the repo market panic. In September 2019, the US repo market experienced its most severe disruption since the global financial crisis, with overnight repo rates spiking, in some cases reaching 10%. So funding liquidity evaporated in what's supposed to be the deepest and most liquid segment of the global financial system. And the initial explanation of this repo market squeeze was a kind of perfect storm narrative. The whole thing was the unfortunate consequence of a confluence of events. In particular, two things were happening simultaneously. US corporations were making their quarterly tax payments, and that drained quite a bit of cash, 54 billion, from the banking system and the money market funds. At the same time, 78 billion of newly issued Treasury securities were settling at around the same time, and these settlements were draining further cash from the money market. And together, these events drained liquidity from the system and produced a temporary funding squeeze. Now, the problem with this explanation is that it cannot explain the persistence of the stress, nor the scale of the Fed's intervention. The Fed intervened immediately on September 17, when it launched this massive reverse repo operations to the tune of 50 to 100 billion daily, and later much more than that. So by the end of the year, the Fed had effectively become the market maker of first resort, a standing liquidity backstop for the entire repo market, which was short roughly of 100 to 200 billion in cash every single day, which the Fed was filling with its repo injections, both overnight and term repos. So this was not a temporary one-off rescue, it was an ongoing life support, call it the great deluge of liquidity. So to understand that, we need to move from the events which triggered this to the structure of the Treasury market. And Bank for International Settlements moved in this direction in a BIS report in December 2019, where it identified three structural developments. One was the Treasury glut, which Nelly also pointed to. So Treasury issuance dramatically increased between 2017 and 2019. At the same time, the Fed was normalizing its balance sheet, conducting QT, shrinking its size, causing this glut of off-the-run treasuries. And the third factor was that the demand for repo financing was surging, largely because of hedge fund treasury basis trades, and that Nelly also mentioned. So hedge funds were heavily exposed to safe assets. They were borrowing a lot to gain exposure to low risk, low return assets. And I think we need to pause for a second on this point before I'll carry on my story of the repocalypse. And because often hedge funds are treated as marginal players, whereas I think in this seminar we all agree that they are not so marginal after all. So their global assets under management are around 5 trillion. So that's the whole industry, which is very tiny compared to the balance sheets of large banks, not to mention giant asset managers like BlackRock, which alone has a balance sheet that twice the size of the entire hedge fund industry. And this has encouraged the idea that hedge funds are some marginal actors, operating in this niche alternative finance ecosystem. But the impression is wrong. And I would say that assets under management, which basically capture the net asset value of the hedge fund industry, are a poor measure of the financial power that hedge funds have. What matters for hedge funds is their gross notional exposure, not the assets that they own outright, including treasuries assets. And when we account for leverage, especially synthetic leverage, derivatives type of leverage, the industry's market footprint expands dramatically. Conservative estimates place it at around 30 trillion. This is based on SEC data on private funds. 30 trillion in 2024, which is quite substantial. And very importantly, this leverage is very highly concentrated. A small group of dominant funds account for most derivatives activity and the great bulk of the gross notional exposure. Top 5 hedge funds matter disproportionately, the rest largely do not. Even the top 10 hedge funds matter disproportionately, accounting for 34% of the total G&E of the industry. So the total gross notional exposure is 8.7 trillion in 2023. That's a lot. Now, these top hedge funds rely on relative value trading, which is arbitrage, convergence trades, so stuff that was pioneered by Solomon Brothers, Meriwether, later in LTCM. So they exploit these tiny price discrepancies between closely related securities. That means cash treasuries versus futures, on the run versus off the run treasury bonds, and so on. And these strategies generate very, very small returns on their own. So leverage is essential. A lot of debt needs to be taken on tiny margins to magnify return on equity for hedge funds. And the margins are really tiny, like $1 for $1,000 exposure to a treasury. And treasuries are particularly cheap to leverage precisely because they're safe. And this explains what is sometimes called the low beta anomaly. Hedge funds can earn high returns not in spite of investing in low-risk assets, low volatility assets, low beta assets, but precisely because these low-risk assets can be leveraged much more aggressively on very thin margins. So we're back to the repocalypse. In the years leading to 2019, the hedge funds were heavily engaged in these treasury basis trades and speculating convergence trades on treasuries and so on. So they're buying, for instance, off-the-run treasuries, shorting on-the-run treasuries on futures, and they're financing the long leg through repo borrowing. And obviously, to be profitable, these trades had to be highly leveraged and therefore extremely sensitive to funding conditions in the repo market. And official reports did acknowledge this activity by hedge funds, but have treated it as marginal. And this applies to this study that I also shared with the participants of the seminar, published by the Office of Financial Research, which is a great study in terms of a lot of the things that are laid out in there. But the problem with this study is that its data only capture the cleared tri-party sponsored segment of the repo market. However, a considerable amount of hedge fund borrowing takes place in the uncleared bilateral segment of the repo market, which is far more opaque. So I don't have data on the uncleared segment, but fortunately, we can look at the hedge funds filings and private fund statistics, which can be found on the website of the Securities and Exchange Commission. And there we find something very interesting. So between 2018 and 2019, hedge funds' gross exposure to US Treasuries doubled, reaching 2.2 trillion. At the same time, hedge funds were also unwinding positions in equities. So they were deleveraging their equities portfolios. Hedge funds were also increasing their exposures to fixed income more broadly and to repurchase agreements, both long and short positions. So that exposure is quite substantial because, to put things in perspective, in September 2019, the total stock of Treasury bills, so not all Treasury securities, but just Treasury bills outstanding, was about 2.3 trillion. A lot of this repo borrowing is funded by collateralizing Treasury bills because that's what dealers are more willing to accept. So hedge funds were likely responsible for a large share of the entire short-term Treasury bill market. If we combine Treasuries and repurchase agreements exposure, we're approaching 4 trillion. It's not a marginal exposure. It's also interesting to note that the hedge funds were also reducing their cash holdings since beginning of 2019, and they were also deleveraging in sort of aggregate terms since the beginning of 2018. And now all of this, to me, raises a number of questions. Really, the deeper question is, why were the hedge funds piling into treasuries at exactly this moment in 2019? And why were reallocating their leverage strategies towards safe assets and while they were unwinding equities since early 2018? And to answer this question, we need to widen the lens further. The instability that was revealed by the repo market panic was embedded in a broader transformation of credit markets more broadly. This is related to what I call the leverage finance complex. Over the past 2 decades, especially during the 2010s, corporate finance has been reshaped by a dramatic expansion of leveraged lending or leveraged finance. Now, leveraged loans are loans extended to highly indebted, speculative grade firms that rarely finance any productive real investment. Instead, what they fund are leveraged buyouts, M&As, dividend recaps, share buybacks, and repeated refinancing. And private equity has played a key role in promoting this type of leveraged finance because private equity sponsors are piling up debt onto corporations as well. Dealer banks have also been involved in this because they've originated and syndicated the leveraged loans. And then they've also securitized them, producing collateralized loan obligations, CLOs, which have grown in size throughout the 2010s. And then hedge funds and private equity firms are dominant investors in the equity tranches of CLOs as well. So they take the largest returns, but also the highest risk in investing in CLOs. Now, there were warning signs about this leverage finance complex building throughout the second half of the 2010s. Corporate debt relative to GDP was growing in the US and reaching historic heights, especially once this sort of like CLO shadow banking complex was taken into account. At the same time, credit quality was deteriorating. Triple B bonds, just one notch above junk status, came to dominate investment grade credit markets, and the Fed, the Bank of England, international institutions like the IMF were increasingly alarmed about the corporate credit cycle, about financially distressed corporations, about zombie companies, and the implications for systemic instability. In 2019, the Bank of England estimated that the leveraged loan market had reached these levels comparable to the subprime mortgage market back in 2008. And then in the summer of 2019, spring, summer, commentators expressing, the sort of alarms about bubbles ready to bust and a downturn into the CLO market going into late July. And more generally, everywhere, people were talking about this global recession coming and so on and so forth. So I guess that this gives us a bit of a context to understand what was happening back in 2018, 2019. So the macro financial context was one of increasing volatility in this leverage finance complex. And by the beginning of 2018, hedge funds started deleveraging their equity portfolios. And this equity volatility rose sharply, and in December 2018, was a near stock market crash, or anyway, the worst December since the Great Depression. At the same time, the Fed was raising interest rates, it's tightening monetary policy, and this was adding pressures onto this leverage finance complex. And in this context, hedge funds were not just abandoning leverage, because leverage is what they do, top hedge funds. So they were repositioning it, migrating towards safe assets. And treasuries offered, this low volatility, deeper liquidity, superior collateral status. And so hedge funds were able to leverage at scale more efficiently at this time of volatility and stress. And unfortunately, this added quite a bit of pressures onto the dealer system. Dealer banks were already stretched. They were warehousing this treasury issuance, which is increasing. They're operating with shrinking reserves. They were holding leveraged loans, many of which were awaiting securitization because the CLO issuance was slowing down as well. So they were holding this pipeline risk. And then, of course, they were lending quite a bit of money to hedge funds in the repo market. So the balance sheets were strained from multiple directions, and the system was essentially primed for a repocalypse, which I think would have quickly escalated to a treasury market panic had the Fed not intervened promptly in September 2019. So I'll conclude with a broader point, and that is that in contemporary finance, the treasuries and safe assets play this dual role. This is the structure of the market. They are both the foundation of financial stability, the safe asset, the safe haven, but they're also the raw material for this leverage speculation. And so there's a paradox that, everybody dealing with financial regulation and governance has to deal with. The safer the asset, the more leverage that tracks from these leveraged speculators. And the more leverage it attracts, the more destabilizing its sudden unwinding becomes. Also because treasuries are the first assets to be let go because they're the easiest to sell at times of stress, right? So safe asset instability is not just some technical malfunction, an imperfection. It is really like embedded into the functioning of the treasury market, the dealer system, and so on. So this is a financial system that is organized around leverage, around securitization, shadow banking, money creation by the dealer system. And so the big elephant in the room is this corporate debt bubble, which is now, much like the subprime bubble, a systemic thing, because everyone is entangled in it via the dealer system, via the hedge funds, via the private equity, and so on. So this is an everything bubble. That's how I call it in the book. And because of this bubble, the repocalypse is not just something that happened. It's something that, might as well happen again. And it's something that would probably again be experienced not as a disruption taking place at the fringes of global finance, like an AI bubble or something happening in the speculative grade markets. It will start at the epicenter of the Treasury market, I feel, in the safest heaven. All right, so I'll stop here. Thank you.
Thank you very much, Stefano. That was really, really great and wonderful context. I think also for the reform efforts by the Treasury and by the Fed that Nelly was talking about. What I suggested earlier when we met is maybe if the two of you would like to react to each other for a moment. If not, and in the meantime, we can collect questions from the audience as well as, I have a few questions, but maybe Stefano, if you just had a question for Nelly of one kind or another, and then Nelly could ask you a question, then that would be great.
Okay, a short question or a quick comment question?
A quick comment question, of course.
Can I articulate the question?
Yeah.
So I think, okay, all right. Okay, so first of all, I think that Nelly and I share a lot in our understanding, and maybe the diagnosis is different, but we do recognize the fact that hedge funds play a key role. I would like to highlight something that I think might be where Nelly and I share a different opinion. That is the way we understand how hedge funds operate and provide liquidity in Treasury markets. So my comment, and I would like Nelly to react, is that in much of the regulatory literature, hedge funds are often described as liquidity providers. So they help absorb Treasury issuance, and then they arbitrage price discrepancies. And in a way, they're also described as increasing efficiency, price discovery, and so on. However, in my work, I focus a lot on how these positions are financed. And hedge funds can obtain Treasury exposure through repo borrowing from dealer banks. So their positions are highly leveraged, dependent on short-term funding. So they're not really lending to the US Treasury, providing liquidity to the US Treasury. They are borrowing to then invest, speculate in the US Treasury. So I think that is probably a point of departure between me and Nelly. And I think that if my interpretation is correct, that hedge funds are borrowing to then speculate in Treasuries markets, the policy implications might be a bit different because they're not just liquidity providers, but they are exploiting liquidity provided by the dealer system to then take positions and generate, gains and profits and so on by investing in safe assets. And so that is a comment that I have in general, and so I wonder how Nelly thinks about hedge funds in terms of whether they're providing liquidity or they're exploiting liquidity, whether they're just borrowing to speculate, because that also has implications for how we understand, and how we should then think about the infrastructure, the dealer infrastructure, which is what is at the heart of Nelly's regulatory interventions, because perhaps providing resilience would make it even easier for hedge funds to borrow from primary dealers in order to leverage their exposures in treasuries and other markets.
Thank you very much, Stefano. Wonderful. Great comment. Great question. Nelly?
Yes. Yes. Thanks, Stefano. And I agree with you. I think we actually have very similar in spirit the way we think about the role of the Treasury market and providing the foundations for the financial system and hedge funds. So I would not say hedge funds are their job is to provide liquidity, but they are a key player in the way Treasury securities are intermediated. And they ultimately purchase securities, but they finance that purchase with repo, right? Because it's a safe asset, the haircuts or the margins that they have to post are relatively low. So if you repo an equity security, your margin could be 20% or 50%. If you repo a treasury security, it could be 2 or 3%. And we found with the dealers, if you put a 5% haircut, that's just too high for a treasury security, and they're not willing to hold those. So I think, in my view, while they aren't lending directly to Treasury, they are indirectly supporting issuance by financing the purchase of securities. Now, and I'm going to bring asset managers in because I think it's a missing piece of the story. Asset managers, you can think of in the CFTC would call them unlevered investors, and they call the hedge fund levered investors. That's their categorization when you think about how these firms work in asset markets. The asset managers technically are not allowed to leverage generally. Okay, say a mutual fund is not supposed to deploy leverage, but it's going to try to meet the aggregate bond index. And all of a sudden, Treasury debt is 40% of the aggregate bond index. And Treasury securities only offer 3 percentage points. And so asset managers would rather buy a future on Treasuries as opposed to the Treasuries themselves, and say pay 4 cents for the Treasury security for the futures, and then they have 96 cents to invest in corporate bonds or MBS or something else to boost their return. Now, they can do this because, one, futures doesn't seem to count as leverage, and the purchase price of a futures is not an interest expense. If they were to buy the Treasury and repo it, then they have an interest expense, and they're not allowed to do that. So I think there's a whole system here, and it's not just hedge funds. And that's probably the biggest distinction in our characterization. It's hedge funds are part of an ecosystem. There's a basis trade. A basis opens up between the futures premium and the underlying Treasury securities, and the hedge funds arbitrage that. And then because you only earn a little on that basis, you have to leverage. And so I think leverage is probably, 20 times. A dealer could leverage 20 or 25 times. The hedge funds probably leverage a little less on average, but just because people aren't going to lend to them at the same terms as others, as like a regulated dealer like a JP Morgan. I think to fix this, central clearing will get you a long way. The dealer, as I said, stands between a money market fund and a hedge fund, and the central clearing would help to standardize margins. And also, like, everyone has the same risk management standards, et cetera. So that will, I think, help to reduce the leverage in this system. But in my view, like, they're just one additional part they're one part of a bigger system. They are not just like on their own. And at the conclusion of my thing, the fundamental problem is not so much the leverage of the intermediaries as much as, which is a problem. I don't want to suggest that's not a problem, but we could fix that. We could fix all the leverage of the financial intermediaries. There's just a lot of government debt. And so I think, like, that to me is, we have to figure out how to keep that market liquid when you have a lot of Treasury debt. And so that's where I would just to round out the picture. But I think fundamentally, we sort of see the issues similar. Is just how we would characterize what the role of a hedge fund is in this space.
Thank you. Thank you very much, Nelly. Very great comments and great clarifications. Now, I do have a few questions, but I don't want to necessarily abuse my privilege of being here the moderator. So if anybody, so Katharina, please.
I think no. Nelly was supposed to ask a question to Stefano as well. We haven't done the reverse, have we?
True.
I mean, if you have one, I'm not, but I just thought this would like be continue the conversation and then we can go open it up.
Okay. So, Stefano, thank you. I really enjoyed the presentation. You talked about an everything bubble related to corporate debt, and that was around before the crisis, say 2018-19. I guess I just wanted to follow up a little bit in terms of, do you still have those concerns? And yeah, do you still have those concerns? I'd started, one of the charts I'd shown was like business debt, household and government debt. And business debt had been rising a lot prior to 2020. And there is a broad ecosystem to support that. But I'm just curious as to, like, is this still a issue that you would be impressing on all regulators now, or if this was something that you were referring to, and then what resolved it, if it's just something in the past?
Thank you, Nelly, for the question. The short answer is yes. I think it's still very much a concern. And the reason is that the sort of pandemic bailouts allowed this everything bubble to be refinanced at very, very cheap rates. And if anything, the inflation surge of 2022, 2023 also helped a few formerly financially distressed firms and sectors to recapitalize because that inflation wave has been termed by many a seller's inflation wave, or it went along with, profit margins, growing profit margins for corporations. So the debts have not disappeared, even though in relation to GDP it might look like there hasn't been some growth, but in terms of sheer size of the corporate credit market and the quality of the corporate credit market, it is still very much of a concern, so much so that it's often found in financial press that leverage finance is a problem. The next refinancing wall for speculative grade debts is coming between 2027 2028, and this is a problem if interest rates don't go down or stay down and so on. So it's definitely not gone away because the debts are still there, very much there. So yeah, that's probably my answer.
Yeah, that makes a lot of sense to me. And sometimes I tended to see the push by Trump for lower interest rates, even in that context that you're raising, but that's probably pure speculation. Now, if there are no questions, and I will let Katharina ask her question. Katharina, please.
So thank you both. This was enormously illuminating. I think my first question goes to Nelly, because I think sort of the concern with sort of too much government debt, of course, is an old one. And I think in the 1960s or early 1970s, it resulted in the launch of securitization. So, we're basically entangled in a system where we think sort of we have to push sort of government debt off, and so somebody else has to offer the debt, and then but then we have to backstop this debt, and we're getting into the system of trying to backstop it, and of course allowing the private sector to get the cream of the system. So I'm just wondering whether, the temptation to say we need to preserve liquidity in markets, and of course now in treasury markets, because that's where we are at any cost. whether this is kind of self-defeating in the long term because it results in the kind of, bubble that Stefano described. On Stefano, I think I just wanted to add that there is actually, I think we have to bring the transformation of corporate debt into the picture. I think it's really important. I'm going to sit on a dissertation defense in about half an hour at 2 o'clock that makes exactly this point and looks at how corporate debt restructuring has changed, not only sort of the nature of debt, of course, that results in it, but also the way in which powerful players use their power to drop the debt to less powerful players and sort of rearrange. I mean, bankruptcy is no longer the thing. We just do this basically through market-based transaction where the most powerful players are doing their thing. So this is more a comment, but I think it's really important to look at this entanglement of private and public debt and the restructuring, not only of the markets for where the big hedge funds are playing, but also the market for corporate debt, because it's part of the same thing. And what we're getting, I think, is a system that is simply ungovernable at this stage. And my fear is sort of that in the next crisis, which of course will come, the next liquidity crisis certainly will come, we'll just flood the system with more liquidity rather than thinking about the root causes that I think hold all major policymakers hostage as well. Thanks.
Thank you. I would suggest we should collect 3 questions and then both of you can answer. I would now like to ask Erin to speak, and then I put myself on the list very selfishly. Erin.
Thank you. And thanks to both the presenters. I was doing a lot of reading over the past summer and fall about stable coins. And one of the points of sort of intersection with the discussion of Treasury liquidity was something I was reading in a BIS paper that really, I think, spoke to what the note Stefano ended on about the sort of dual role that treasuries play in the market, where the more they become a safe haven, the more they become the asset that a stable coin is pegged to, the more that when there's a sudden unwinding, they become destabilizing. And so I had read a BIS paper that spoke to this and was trying to think through the risks associated with a sudden unwinding of positions. Where there has to be a drawdown on the Treasury bill side, and what that would do, not so much to the market for stablecoins, although there's all sorts of concerns there, but what that would do to the Treasury market. And I was just curious if this is just like a fringe concern, or how sort of central this is, especially with the Genius Act in the United States, and the prospect of this becoming a real substantial sort of piece of the market. How folks both on the sort of regulatory side, which maybe Nelly can speak to, but Stefano, also how this sort of maybe is another set of actors that you need to maybe would fit into your already, I think, quite helpful mapping of this space of leverage and liquidity, or whether this is just like a totally fringe scenario that some people are worried about, but is really not central to these dynamics. So I'd appreciate both of your thoughts on that.
Thank you. Thank you. So let me step back from and let Anna ask the third question. No, as you want.
I mean, I can do it very, very quickly, but I didn't want to preempt your question, Matthias. So, so thank you very, very much. The question that I'm struggling with is I'm looking at both your presentations as sort of, rather than Treasury uniqueness as a case study, right? And I'm thinking about a hypothetical that, we hear about a lot more now, about some reasonably large scale reallocation away from the treasuries, just as a hypothetical proposition, right? What you're showing, both of you, is sort of a giant ecosystem that is it's a very elaborate structure that is also very nimble and very tightly enmeshed in public governance. So where else can we observe this? I mean, this is really, where does the money go, and what does that destination ecosystem have to do to have a prayer of even absorbing a fraction of the flows that are now sloshing around, I guess, for lack of a more polite word, in this ecosystem. Thank you so much.
Thank you very much. So now, Stefano, Nelly, whoever of you would like to go first.
Let me start. Or I can start. No, I'm happy to start. Katerina, I think your point, I think you were asking why all these efforts to preserve market liquidity if it's just creating bubbles. I mean, I think the fundamental part of Treasury market reform was it is the cost to the US of financing its government. And to the extent that we want lower interest rates, all else equal, because that raises the US standard of living, then you want lower interest rates. And lack of liquidity, the inability to sell your securities when you want to, would lead to higher interest rates. I think that's the fundamental reason for the importance of Treasury market liquidity. And then you get into how do you keep that market liquid? But the goal is liquidity first, because if you buy a Treasury security, knowing you can sell it if you need to, that will keep your interest rates lower. And I think lower interest rates, all else, is good for the US economy. I think so that I would just say that's like the fundamental, first principle of Treasury market reform.
I think if I may, just my question was also a little bit the concern that you expressed, I think at the beginning, at the end of the talk, is about the amount of government debt.
Sure.
So then, of course, the question is as compared to what, right? Because if these markets need assets to do their thing, to leverage and to trade and to make money on them, they will have to find something. And so in the 1970s, we did securitization, and that blew up in 2008. And now basically we have a market where we are trying to backstop everything the private market is doing and preserving treasury liquidity no matter what. But what we're creating is
fair enough.
That can
So I think the securitization, they created safe assets where there were not Treasury securities. But there is, I would just at the end of my thing, we have government debt growing at the expense of household debt, which is what the securitization was. But there is some limit, and maybe that's the debt service capacity or the ability, like there are some limits to how much debt there is. So there should be. So I guess I would and I think we're hitting that limit because you can see the share of institutions or the non-price sensitive investors shrinking pretty notably in the last few years. On stable coins, that has been a concern. I think the Genius Act allows stable coins to purchase Treasury securities, Treasury bills of 93 days or less. For even the sort of the big projections that it could be $2 or $3 trillion. So stablecoins now are about 290 billion. Suppose they really, made a big inroad in cross-border payments and got to 2 or 3 trillion. We have close to 7 trillion of bills and 7 trillion in money market fund assets. So I don't think stablecoins will be like the dominant market in that space. So it's not fringe. I wouldn't say it's fringe, like a fringe view, but I just don't, unless for some reason stablecoins are much more successful than they would be. And Anna, in terms of like the giant ecosystem, like a reallocation, there are, many countries are trying to put themselves in a position to be able to provide a safe haven currency. And creating trading systems that don't need the US. And so why should they be denominated in dollars? There's quite a bit of work going on in that, by many countries for that. For now, there really isn't a easily viable alternative. So we continue to benefit from the lower rates afforded a safe haven asset. And even in this current war, we've had some safe haven flows. But it is financial markets continue to be, become even more globally integrated. And I just don't think it's something U.S. can take for granted.
Wonderful. Stefano? Thank you. Stefano?
Okay. Thank you. So I want to say something about so Katharina asked me about the transformation of corporate debt, which is also very important. And I only touched upon it, well, I only mentioned a little bit of that in the presentation, but in the book, I'm looking at the history of private equity and its interaction with corporate debt and changes in corporate debt governance as well. So it is something that is actually very, very central to understanding the ways in which finance is transformed, especially in the last quarter century. But of course, going back to already 70s and 80s. On stable coins, Erin, I know very little. So I think Nelly has said something that is far more than I can ever say. So I'll probably just skip that. And I just want to say something about following up on something that Nelly said in a response to my question on enlarging the scope of the analysis and bringing in also the asset managers, the various asset managers who prefer to invest in futures as opposed to buy the actual treasury bonds or securities because the yield is too low. I think that's really key. When Nelly said that, it's really key because I believe that one of the key reasons why the yield is low and a great host of unlevered asset managers, mutual funds, institutional investors, and so on, sort of operating in more exotic ways has to do with the fact that the hedge fund leverage operates procyclically, meaning it is driving trading in the capital market, in the bond market, in the treasury market, and that produces higher liquidity, market liquidity in the market. In that sense, Nelly is right to say the hedge funds help increase the liquidity of treasuries, but that also has a procyclical effect. And that means that, the liquidity of treasuries improves as well as the funding costs for the US Treasury, which is able to sustain this growing debt. But they also compress yield, which is what we've had, for decades, basically. And this pushes all sorts of non-levered investors to seek this yield elsewhere. And that's why the financial system is driven towards more risky investments and so on. And again, and that also then comes back, with the problem of the US debt. Trying to now reduce or contain the growth of this factory of safe assets means that some safe assets or pseudo-safe assets will have to be manufactured somehow through securitization, shadow banking, and so on, the moment the investor community increases its preference for liquidity, meaning cash as opposed to investment. So it's a very difficult, seemingly unsolvable dilemma for public debt management and governance, I'd say.
Could I clarify something, Matthias, here? So I did say low, and there's two elements to low. One, I think at an absolute level, as you were saying, and some will pin that blame on the Fed for doing QE, but that was their objective. But I also meant low, and this is where I misspoke, in terms of relative to what you can earn on a risky asset. So many fund managers target a benchmark, but their goal low is to actually beat that benchmark. And so, because then they get more inflows. And so, but with more government debt, which is growing from, say, 20% of the index to 40% of the index, they don't just want the government returns, because that's too low. But again, it's all relative. So they want to get the interest rate risk or the duration of the risk-free asset. So they buy treasuries, and then they can then purchase corporates to get the higher spread. And so there's low and there's the absolute level, which again might be because of the Fed's purchases for monetary policy. But then there's sort of a relative low relative to the credit risky assets. Then you could try to beat a benchmark. And that is in some sense what sort of creates this cash futures trade in my view.
That's super fascinating because it actually in a sense answers the question where the arbitrage that the hedge funds exploit comes from. And
Yeah,
that's the asset manager, and then the two need to be thought together. I would like to ask a few questions, and then we also have Jacopo, who has added another question. And those of you who would like to add another question, please feel free. I think maybe at least I can go a little bit over. I don't know how you feel about it, but so my questions are on the one hand to Stefano about I share your view on this ecosystem that is growing and that is procyclical. I was wanted to ask about opposing interests. So in a sense, you're drawing rightly the question of the system and how it has together inflated this everything bubble. But aren't there also opposing interests, and how might they affect the unfolding of the system? And hopefully my next question to Nelly will make this a little bit more explicit, what I mean by that. So for example, my questions to Nelly, they relate a lot to these reform efforts that you had, and they are on the one hand, and thank you, Stefano, you reminded us about the reverse repos that now back up the entire repo market and the entire system by the Fed. And I think a lot about the resilience reforms of the Treasury market were undertaken also to satisfy concerns of a moral hazard by the Fed. But maybe I'm wrong, but so I would like to know if people at the Fed today are happy with the reforms that have been undertaken with respect to the Treasury market. What was the pushback? And in particular, I'm wondering about two actors, the asset fund managers, and if you were trying to push there and how they reacted. That's one question, Nelly. And the second one, that's the question about CCPs to me, because when I did research on CCPs in Europe, the important element was where do the benefits from netting go to? And there was a big fight between the banks and the CCPs, even if partially the CCPs are collaborating / owned by the banks. But there was this big fight. Where's the margin going to go now? And Stefano, that's a little bit where my question is, right? There's a struggle in this ecosystem where everybody seeks to get margin, right? And how does that structure the evolution of that system? So that's my question. So how was it possible for the Treasury, and Nelly, where you've been, to manage these opposing interests in the attempt of getting reform, would be my question. And then we have Jacopo who asked a question. Jacopo, do you want to read your question, or you need to unmute yourself, please?
Yeah.
Sorry. Yes.
Okay, sorry. So no, my question was just related to the fact that there are different agencies involved apparently now in this kind of reform process of the Treasury, and maybe also building up a little bit on what Matthias was asking, like how are these, if you can share something about how these different agencies are approaching this reform, like what's their perspective, what are the expectations, what are the key goals? Are they common, or there are differences with the way they approach this reform process? And thank you.
Shall I go first, since I will be very, very brief? Who are the opposing interests, Matthias? As you know, I am not really versed in the sort of behind the scene conflicts around financial monetary governance regulation, I look at what goes behind the scene of private sector finance, let's say that. So conflicts there for sure, because not everyone is pursuing the same goals. So the asset management ecosystem is a vast constellation. And even within the hedge fund sector, as I said, you have top hedge funds, highly leveraged, making lots of profits, and small hedge funds, broadly unlevered. So you have hedge funds who can't leverage as much as they want to. So, that's I think I can only answer that question in a different way. And that is when it comes down to the sort of social conflict or social sort of issues. The bigger question is, why are there no opposing interests? Meaning it seems to me that the sort of conflicts emerging by means of finance are making the sort of degree of I don't know, conflict, exploitation, however you want to call it, quite illegible to some extent, because all of this is happening on the lingua franca or balance sheets, and so it becomes very difficult to understand who people are dealing with when the owners are hiding behind all these layers of leverage and LLCs and so on. So that is the only thing I can say.
Thank you. That's very interesting still. I mean, we can continue this discussion. But, sorry.
And maybe just to build on that, usually when there is leverage building up in the financial system, the Federal Reserve has a very important role to play, because they see that as creating downside risks to economic growth in the future because the bubble bursts. And so they have while financial stability is not an explicit mandate of monetary policy, they are a macro-prudential authority, and they do want to consider where the debt growth is credit growth is that might create a bubble and then pop and then cause a steep, deep recession. They have not been as concerned about the corporate debt growth, in part because, as you say, debt is not growing that much faster than GDP. And it isn't financed as much by short-term funding as, say, the household debt growth of 2008, where they created safe assets and short-funded them. So they are an opposing interest. They do pay close attention. They are flagging this, but it isn't the kind of the alarms that at other times it might have been. But I just flag that. That just goes into like the reforms for Treasury markets per se, as opposed to all credit growth. As I mentioned, this was a work of an interagency working group. And that, in part, sort of was created recognizing that every entity has slightly different responsibilities and obligations, and they may not always be aligned. And so this group was created to try to come to a consensus on different things. The Federal Reserve is part of that group. And I would say, like in the case of asset managers, we didn't get anywhere. And the reality is the securities regulators view their responsibilities to be investor protection, and they rely on disclosures and enforcement against rules, and not on sort of a broader financial stability mandate that maybe we're driving up futures prices and that's creating some too many trades that have to be leveraged and cause problems for the system. That's not their thing. They want to make sure that the investors who buy those mutual funds have the disclosures and are protected. Nonetheless, the SEC was very instrumental in the group, especially on CCPs. They were the ones to write. They have the authority to write the rules to expand central clearing. No other agency had the authority to write that. I would say in general, the Fed was concerned about centralizing risk in a one CCP, like in a single CCP. I mean, if risks are distributed, but then you centralize them, then you have to worry about a CCP. And so, like, is that the system you want? And I would say there's actually been 2 new entrants to centrally clear. So there could be 3 CCPs, which from my point of view is a win for everybody. Even if it's not a third, and it won't be because each meets a niche. It's better for operational resilience and all kinds of reasons to have 3. So that was, and then in terms of just like who gets the benefits. So I think the banks and the dealers benefit because they can net with the CCP. The CCPs get the benefits of just more transactions. I think it raises the costs of Treasury market transactions a little, but at the benefit of reducing the risk of that really bad blow up in margins or, the fire sales. And there will be work to try to make it more efficient and keep the costs down, but that's one of the costs. So the industry did not like it for a while, but now everybody's moving, and I think it will get implemented for securities the end of this year, by repo June 2027. And in fact, it's already been moving even before the deadline. So, but whenever you change something, some people lose, some people win. And many of these reforms were around trying to reduce systemic risk.
Yeah, no, from a European perspective, it's interesting to see that Europe was 10 years before acting on this. I mean, it's an interesting, even if the US is so much more sophisticated, maybe in terms of overall.
Yeah. No, as I mentioned, like there was no single regulator for Treasury securities, and that's one of the issues. And derivatives all got moved much earlier, and equities are centrally cleared, and exchange traded derivatives are centrally cleared. It was just Treasuries.
Okay, thank you. Is there now another question from the floor? If I just wanted to maybe clarify before Stefano, in your everything bubble in this ecosystem, I mean, there seems to be, the way that you put it, Amos, there seems to be a general alignment for ever more liquidity, and that's something that I'm trying to. Is everybody in the short term benefiting? I mean, I found Nelly's answer very poignant when she said, "Look, we as the public officials, we want lower interest rates. More liquidity gives us lower interest rates. That's why we go for it." So is it the way that you put it, Stefano, basically it's never going to be resolved, or how do you see it? If I may ask.
So,
Nelly.
I mean, it is a system that is feeding on. Sorry, I'm just answering since you.
Yes, I asked you.
So it is a system that is feeding onto itself, right? So and driving this on the driving seat is this dealer ecosystem that comprises, the main borrowers there, which are hedge funds. Private equity does the same, but in the leverage loan market. So they are anyway dealing with the dealer system, right? And this has a procyclical effect on prices, so it compresses yields, it makes leverage a level cheaper, and all of that. So it is, and it has a trickle-down effect on passive asset managers as well, because of course all this highly leveraged trading activities, they produce, liquidity as well as hype. So in the corporate markets, it means that you have in the debt markets you have highly liquid markets, but in the stock markets you also have this ballooning equity values, which are driven by corporate debt governance, because again, leveraged loans are very much about maximizing shareholder value. They're about producing, shareholder value. So that drives stock market hype. And BlackRock and the other passive giant asset managers are, benefiting from this effect in the short term, of course. But it is also something that has distributional implications for different financial market participants. So if you look at hedge funds versus pension funds, pension funds are invested in hedge funds, but pension funds have been investing in hedge funds, especially American pension funds, since they got burned by dot-com bubble and then the great financial crash, the compression of yield that is forcing them essentially to direct more and more funds towards hedge funds. So they're burning more and more of, retirees' future savings, so that this system can carry on. In 2020, in the year where everybody suffered, the economic recession and BlackRock portfolio shrank by, 10%, hedge funds had a record profit year. So especially in times then of great volatility, the leveraged ecosystem, which comprises insider traders in the sense of those who initiate the leverage trades, are also the ones who are able to learn more softly than others. And they're also the one who benefit disproportionately more from institutional support, because clearly the bailout, the QE are all measures that are required to enable leverage in the system to be sustainable, to continue, right? And in that sense, it provides an implicit, actually quite explicit subsidy to this type of activities. These are zero-sum games in the end. If somebody's making 5% on their portfolio and somebody else is making 35% on their portfolio, it seems like both are winning, but there are differential gains there, right? So in that respect, it becomes difficult to discuss this from a class perspective. If you say opposing interests in the sense of political opposition to this, is very difficult because things are very messy, and because the ones who are actually burdened with the actual costs of these leverage infrastructures are people who are, for the most part, not really at all familiar with what's happening with the financial plumbing, with all the architecture that we are discussing here. So it's very difficult for somebody to understand, when they're paying rent to their landlord, which is a private equity company that has, they're actually feeding into the system. Although people do get that, but the political opposition is a bit more difficult to achieve.
Yeah.
Thank you. Nelly, thank you.
Yeah, if I could just, I think you're asking, a really important question, but I guess my perspective is this is not a zero-sum game, that financial intermediation in general and our capital markets have allowed the US to grow and invest in ways that, other countries have not been able to. Now, we have leverage that can become excessive, but I don't think leverage is unique to the United States. And the bubbles are not unique to the United States. And so I think it's about finding the balance. And I guess I would just say, I don't think this is zero sum. I think it creates value through capital markets and the associated derivative activities, which I think we'd all like more transparency on and would all like a little less leverage on. But the goal is to facilitate productive investment by either businesses or households in residential investment and businesses and plant and equipment and structures through markets. And, and so the US has a more market-oriented system than many countries, which rely much more on banks. And so we just have to, and since we rely so much less on banks now than most countries, say 25% of our lending is banks, and say Europe, 80% of lending is banks, you need market liquidity to be able to support that financing, because they don't have access to the reserves of the Federal Reserve System for liquidity. And so my view is, in some sense, we have a more healthy system than countries that rely only on banks. So I guess that's why I don't think it's zero sum. So that was just a comment I want to add to the discussion.
Okay. Yes. Thank you very much. If there's right now no further question, I would like to take this opportunity to thank both of you, Stefano and Nelly, for really informative, passionate, and very well informed contributions from both of you. I would like to thank the audience for being here and for discussing with us these matters, which I think matter a lot. And we're looking very much forward to having you in the future. Yes. So thank you very much. Have a great day, evening, afternoon, wherever you are. Okay. See you soon.
Thank you. Thank you, Matthias. Thank you, Stefan.
Thank you, Nelly. Thank you, everyone. Bye.
Ciao.